Section 5.1 to 5.2 Understanding Short Selling, Advanced Short Selling Techniques, 5.1 Pair Trading and Market Neutrality, Long-Short Strategies and Market-Neutral Approaches are two popular investment strategies used by hedge funds and institutional investors. Let's explore each strategy in more detail. Long-short strategies. Long-short strategies involve simultaneously taking long positions in securities expected to increase in value, going long, and short positions in securities expected to decrease in value, going short. The goal is to profit from both rising and falling markets, regardless of the overall market direction. In a long position, an investor buys a security with the expectation that its value will increase over time. In contrast, a short position involves selling borrowed securities with the intention of buying them back at a lower price in the future. By combining long and short positions, investors aim to reduce exposure to general market movements and generate returns from security-specific factors. This strategy allows them to potentially profit from successful stock picking while minimizing the impact of broader market fluctuations. Long-short strategies require extensive research and analysis to identify undervalued securities to go long on and overvalued securities to go short on. Risk management is crucial as losses on short positions can be theoretically unlimited. Market-neutral approaches. Market-neutral strategies are designed to generate returns while maintaining a neutral exposure to overall market movements. This approach aims to remove systematic or market risk and focus solely on security-specific factors. The market-neutral approach typically involves establishing a portfolio with equal long and short positions, thus creating a neutral position regarding market direction. The objective is to capture the relative performance of individual securities within a particular market sector or industry. Market-neutral strategies can be implemented in different ways, such as pairs trading, statistical arbitrage, or sector rotation. These strategies involve identifying pairs of securities or assets that are expected to have a high degree of correlation and taking long and short positions in those pairs. By hedging out market risk and focusing on relative performance, market-neutral strategies aim to generate returns regardless of whether the overall market moves up or down. However, they still carry risk, such as specific company risks or unexpected changes in correlations. Market-neutral approaches require sophisticated modeling, statistical analysis, and risk management techniques to identify and manage trading opportunities effectively. Both long-short strategies and market-neutral approaches are advanced investment strategies that require significant expertise, research capabilities, and risk management discipline. They are often employed by professional investors and institutional funds seeking to generate consistent returns while managing risk exposure. Individual investors should thoroughly understand the complexities and risks associated with these strategies before considering their implementation. Implementing statistical arbitrage and sector rotation strategies involve specific approaches and considerations. Here's an overview of each strategy. Statistical arbitrage. Statistical arbitrage is a strategy that seeks to profit from pricing inefficiencies or mispricings in related securities. The approach involves identifying pairs or groups of securities that have historically exhibited a high degree of correlation and exploiting temporary deviations from their expected price relationship. The process typically involves the following steps. A. Pair selection. Identify securities or assets that have a historical correlation, such as two stocks in the same industry or two similar ETFs. The selection is based on statistical analysis and modeling techniques. B. Establishing the spread. Determine the spread or the expected price relationship between the selected pairs. This can be done by calculating statistical measures such as mean reversion, cointegration, or standard deviation. C. Monitoring and trading. Continuously monitor the selected pairs for deviations from their expected relationship. When a significant deviation occurs, initiate trades by taking long and short positions in the respective securities. The idea is to bet on the convergence of prices back to their historical relationship. D. Risk management. Implement risk management techniques to mitigate potential losses. This can include setting stop-loss orders, position sizing based on risk tolerance, and managing overall portfolio exposure. Statistical arbitrage requires robust quantitative modeling, access to real-time market data, and a disciplined execution process. It also requires continuous monitoring and adjustment of positions to capture short-term pricing inefficiencies. Sector rotation. sector rotation is a strategy that involves shifting investments between different sectors of the economy based on their relative performance and the stage of the economic cycle. The goal is to allocate capital to sectors that are expected to outperform while avoiding those that may underperform. The process typically involves the following steps. A. Economic analysis. Analyze macroeconomic indicators, such as GDP growth, interest rates, inflation, and employment data, to determine the current stage of the economic cycle. This helps identify sectors that historically perform well in specific stages. B. Sector selection. Identify sectors that are expected to outperform based on their fundamental analysis, relative valuation, and growth prospects. This can involve analyzing sector-specific data, financial statements, industry trends, and company news. C. Portfolio allocation. Adjust the portfolio allocation by overweighting sectors expected to outperform and underweighting or avoiding sectors expected to underperform. This can be done by buying sector-specific ETFs, sector-focused mutual funds, or individual stocks within the chosen sectors. D. Regular review and rebalancing. Regularly review the performance of sectors and make adjustments to the portfolio allocation as market conditions change. This ensures that the portfolio remains aligned with the evolving economic and market trends. Sector rotation strategies require a deep understanding of the broader economic landscape, sector-specific dynamics, and risk management techniques. They also require diligent monitoring and timely execution of trades to capture opportunities as economic conditions evolve. It's important to note that both statistical arbitrage and sector rotation strategies involve risks, including execution risk, market volatility, and unexpected changes in correlations or economic conditions. Thorough research, backtesting, and risk management practices are essential before implementing these strategies. Risk management is crucial in market-neutral trading strategies to protect capital and mitigate potential losses. Here are some risk management considerations to keep in mind when implementing market-neutral trading strategies. Diversification. Maintain a well-diversified portfolio by spreading investments across a variety of market-neutral positions. This helps to reduce the impact of individual security-specific risks and increases the chances of capturing overall market-neutral returns. Correlation analysis. Conduct thorough correlation analysis to ensure that the pairs or groups of securities selected for market-neutral trading have historically exhibited a high degree of correlation. Avoid relying solely on historical data. Regularly monitor and reassess the correlation relationships to adapt to changing market conditions. Risk monitoring. Continuously monitor the positions and their respective risk exposures. Implement risk management tools and processes to track risk metrics, such as portfolio beta, standard deviation, and maximum drawdown. Regularly review and analyze risk reports to identify potential vulnerabilities and take appropriate risk mitigation actions. Stop-loss orders. Utilize stop-loss orders to limit potential losses on individual positions. Determine appropriate stop-loss levels based on the risk tolerance and volatility characteristics of the specific pairs or groups of securities. Adjust stop-loss levels as market conditions change to protect against adverse price movements. Position sizing. Determine the appropriate size for each position based on risk management principles. Consider factors such as the volatility of the securities, the correlation relationship, and the overall risk exposure of the portfolio. Avoid overly concentrated positions that may increase vulnerability to specific risks. Stress testing. Conduct stress tests to assess the impact of extreme market conditions or unexpected events on the market-neutral positions. Simulate scenarios that could result in significant market disruptions or changes in correlations. This helps identify potential vulnerabilities and refine risk management strategies accordingly. Liquidity management. Pay close attention to the liquidity of the securities involved in the market-neutral trading strategy. Illiquid securities may pose challenges when entering or exiting positions, which can impact risk management. Ensure there is sufficient liquidity to manage positions effectively and consider potential slippage or impact costs when executing trades. Ongoing monitoring and evaluation. Continuously monitor the performance of the market-neutral positions and assess the effectiveness of the risk management strategy. Regularly review and analyze trade data, risk metrics, and performance metrics to identify areas for improvement and refine risk management practices. it's important to note that market-neutral trading strategies, while designed to reduce exposure to overall market movements, still carry specific risks such as idiosyncratic risks, unexpected changes in correlations, and model risk. Thorough risk assessment, proactive risk management, and continuous monitoring are key to mitigating these risks and optimizing the risk-return profile of market-neutral trading strategies. 5.2 Option strategies for short selling. Utilizing put options is one way to gain short exposure in the market. A put option is a financial derivative contract that gives the holder the right, but not the obligation, to sell an underlying asset at a predetermined price, strike price, within a specified period, expiration date. Here's how put options can be used for short exposure. Buying put options. As a buyer of put options, you can profit from a decline in the price of the underlying asset. By purchasing put options, you have the right to sell the underlying asset at the strike price, even if its market price falls below that level. This effectively gives you a short position on the underlying asset, hedging existing long positions. If you already have long positions in a particular stock or security and want to protect against potential downside risk, you can buy put options as a form of portfolio insurance. If the price of the underlying asset decreases, the put options can offset some or all of the losses in the long positions. Selling put options. As a seller, also known as a writer, of put options, you take on an obligation. You receive a premium for selling the put options and, in return, you are obligated to buy the underlying asset at the strike price if the buyer of the put exercises their right. Selling put options can be seen as a way to generate income, but it also entails the risk of having to purchase the underlying asset at the strike price if it declines in value. It's important to consider the following when utilizing put options for short exposure. Option premium. The cost of buying put options or the premium received for selling put options is an important factor to consider. The premium represents the upfront cost or potential income associated with the option contract, strike price, and expiration date. Selecting an appropriate strike price and expiration date is essential. The strike price determines the price at which you have the right to sell the underlying asset, and the expiration date sets the time frame within which the option can be exercised. Volatility and time decay. Options are influenced by factors such as market volatility and time decay. Changes in implied volatility can affect the price of options, and time decay erodes the value of options as they approach expiration. These factors can impact the profitability and timing of option trades. Risk management. As with any investment strategy, risk management is crucial. Assess the potential downside risk and determine an appropriate position size for your option trades. Set stop-loss levels or other risk management mechanisms to limit potential losses. Option liquidity. Ensure that the options you are trading have sufficient liquidity, allowing for ease of entry and exit. Illiquid options may have wider bid-ask spreads, making it more difficult to execute trades at favorable prices. It's important to note that trading options, including put options, involves risks, and it requires a solid understanding of options and their associated risks. Consider consulting with a financial professional or options specialist to gain a deeper understanding of how to effectively use put options for short exposure and to assess their suitability for your investment objectives and risk tolerance. When it comes to minimizing risk and maximizing gains, here are some strategies to consider. Diversification. Diversify your portfolio by allocating your investments across different asset classes, industries, sectors, and geographic regions. Diversification helps reduce the impact of individual investment risks and increases the potential for capturing returns from different sources. Risk assessment and management. Conduct a thorough risk assessment of each investment before making a decision. Consider factors such as volatility, liquidity, company fundamentals, and market conditions. Implement risk management techniques such as setting stop-loss orders, using trailing stop orders, and employing position sizing strategies. Asset allocation. Determine an appropriate asset allocation strategy that aligns with your investment goals, risk tolerance, and time horizon. Spread your investments across different asset classes, such as stocks, bonds, cash, and alternative investments, based on your risk-return objectives. Regular monitoring and review. Regularly monitor and review your investments to stay informed about market developments and changes in the fundamentals of your investments. This allows you to make informed decisions, make necessary adjustments, and take advantage of opportunities or mitigate potential risks. Long-term investing. adopt a long-term investing mindset and avoid chasing short-term market fluctuations. Focus on the underlying fundamentals of your investments and their long-term growth potential. Avoid making impulsive investment decisions based on short-term market noise. Fundamental analysis. Utilize fundamental analysis to assess the intrinsic value of investments. Analyze financial statements, company fundamentals, competitive positioning, and industry trends to identify undervalued assets with growth potential. This approach can help you make informed investment decisions and minimize the risk of overpaying for assets. Technical analysis. Incorporate technical analysis tools and indicators to identify potential entry and exit points for your investments. Chart patterns, trend lines, moving averages, and other technical indicators can provide insights into market trends and price patterns. However, it's important to use technical analysis as a complementary tool to other fundamental analysis techniques. Regular rebalancing. Periodically rebalance your portfolio to maintain the desired asset allocation. This involves selling overperforming assets and reallocating funds to underperforming assets. Rebalancing helps to control risk exposure and capture potential gains. Education and research. Continuously educate yourself about investing and stay updated on market trends. Economic indicators and industry news. Conduct thorough research before making investment decisions and consider seeking advice from trusted financial professionals when needed. Emotional discipline. Practice emotional discipline and avoid making impulsive investment decisions based on fear or greed. Stick to your investment plan and avoid succumbing to short-term market fluctuations. Keep a long-term perspective and focus on the overall strategy rather than reacting to short-term market noise. It's important to note that investing involves risk, and there is no guaranteed strategy for minimizing risk and maximizing gains. Each individual's risk tolerance, financial situation, and investment objectives may vary. Consider consulting with a financial advisor or professional to tailor strategies to your specific circumstances. Understanding options pricing and volatility dynamics is essential for effectively trading and utilizing options. Here are some key concepts to consider. Option pricing models. Options are priced using various mathematical models, with the Black-Scholes model being one of the most commonly used. This model considers factors such as the underlying asset's price, strike price, time to expiration, risk-free interest rate, and volatility. Other models, such as the binomial model, also take into account discrete time steps and potential price movements. Option premium. The price of an option, known as the premium, is influenced by intrinsic value and extrinsic value. Intrinsic value is the difference between the current price of the underlying asset and the option strike price, for in-the-money options. Extrinsic value, also known as time value, reflects factors such as time to expiration, implied volatility, and the potential for future price movements. Implied volatility. Implied volatility is a key component of option pricing. It represents the market's expectation of future price volatility of the underlying asset. Higher implied volatility leads to higher option premiums, as it indicates a greater potential for larger price swings. Conversely, lower implied volatility reduces option premiums. Historical volatility. Historical volatility measures the past price fluctuations of the underlying asset. It provides insight into the asset's price volatility over a given period. Historical volatility can be used as a reference point for comparing current implied volatility levels and assessing the potential relative attractiveness of options. Volatility skew and smile. Options on the same underlying asset but with different strike prices or expiration dates can exhibit varying implied volatility levels. The volatility skew refers to the difference in implied volatility between options with different strike prices. The volatility smile refers to the pattern where implied volatility is higher for at-the-money options compared to options that are either in the money or out of the money. Vega. Vega is a measure of an option's sensitivity to changes in implied volatility. It indicates the potential impact of a 1 percentage point change in implied volatility on the option's price. Options with higher Vega values are more sensitive to changes in implied volatility. Volatility trading strategies. Traders can take positions based on their views on implied volatility levels. Strategies such as volatility spreads, straddles, and strangles involve buying and selling options with differing strike prices and expiration dates to capitalize on changes in implied volatility. Volatility Index, VIX. The VIX is a popular measure of market volatility and is often referred to as the fear gauge. It represents the market's expectations of future volatility based on S&P 500 index options. The VIX can be used as a tool to gauge overall market sentiment and assess the potential risk environment. It's important to note that options pricing and volatility dynamics can be complex, and various factors can influence option prices beyond those mentioned above. Consider utilizing options pricing models, conducting thorough research, and seeking advice from professionals with expertise in options trading to gain a deeper understanding of these concepts and their implications for your trading strategies.